If you watched my video last Monday, you know that I flagged 57,000 jobs as a growth scare. And here's what happened next. The, the Atlanta Federal Reserve's GDPNow model for Q2 of 2026 had GDP growth fall to 1.2% on July 1st. That is down from 2.5% on June 25th, a drop of 130 basis points in just 6 days. Now, if you combine that with the inflation that's still running above 4% and a Federal Reserve that is still yet hasn't signaled a pivot point, that is a stagflationary setup that investment real estate planners have to price into every deal structure for the second half of 2026. Now, let's get deeper into that June's job report. The headline was adding 57,000 jobs, non-farm payrolls against a consensus of what they were hoping for of adding 115,000. But the April and May figures were revised down to a combined 74,000 jobs. And so the trailing 3-month picture is substantially weaker than the single month headlines are suggesting right now. The unemployment rate also ticked down to 4.2%, but only because labor force participation fell 0.3% to 61.5%. That's the lowest reading since March 2021. Now, when people stop looking for work, they're no longer counted as unemployed, right? The average hourly earnings rose 3.5% year over year, which is great. However, that is down from 3.8% in May. And that's signaling that wage growth is softening even in a tighter labor market. Initial jobless claims for the June 27 week came in at 215,000. That is below the 220,000 forecast, which is actually contradicts the NFP miss and adds ambiguity, if I can get it out, to the labor picture. Here is why all of this matters more than the rate number. The Federal Reserve cannot cut rates to support the housing while inflation is still above 4%. But it can also not aggressively hike to the 1.2% range for the GDP growth without risking a real recession. That's a trap. And here's what most analysts are not saying clearly. The investment real estate market, we're not waiting for the Fed to come and rescue us, right? The deals that are getting done right now are getting done by investors that are running their numbers and budgeting for the 6.5 to 7% on that exit loan. And they're still finding positive returns. Those are the deals that you want to be in right now. So be picky. They're there. And I just want to take a quick break because if this is something that you're finding useful, make sure you follow me. Hit that subscribe button right now. This channel exists to give investment property buyers and borrowers a clear data edge advantage every single week. I give two informational videos and one educational video. So make sure you hit that follow on Facebook and LinkedIn, and let's jump right back into it. So West Texas Intermediate crude is sitting at $68 to $69 per barrel, which is down $7 per barrel since June 22 and June 22nd, and that's down 28% from the pre-ceasefire peak. June was the worst monthly performance of the WTI since late 21. Trump-Iran nuclear talks were ongoing in Qatar as of July 1st, and if oil holds to 65 to 75s, the June Consumer Price Index could print below 4% for the first time since before the conflict. Now, on the tariff side, the Section 301 forced labor tariff commitment period closed July 6th. Now, the public hearing was actually July 7th, and the finalization expected to be around July 24th. So building materials and scope at 10 to 12.5%. Now, Section 232 goods steel, rebar, copper, HVAC, that kind of stuff, remain at 50% for steel. And they're sitting at 15% for the HVAC through December 31st of 2027. Now now you need to be expecting 5 to 10% increases on non-Section 232 imported building materials for August renovations. The investor action plan for this week is run your rehab projections at both current material pricings and at 10% escalation scenarios effective for August. Now, if your fix and flip deal only pencils at the current cost, you need to have you have a single point of failure, right? That's your budget. The operators and the investors right now that are winning are the ones that are budgeting for this environment and the tariff scenario. You got to do that from the start if you want to be successful. Tuesday, I'm going to be hitting the foreclosure data, the Adam May 2026 numbers, and the SCOTUS ruling that just changed the landscape for tax sale acquisitions. Wednesday, I'm going to be hitting the spring fall 2026 market picture. Thursday, I'm hitting the pre-graphic of the hottest and coldest markets heading into Friday's video. And on Friday, I'm going to hit the full Coeur d'Alene and Spokane local market deep dive, plus the complete regulatory countdown. If you want the actual loan scenario, if you have an actual loan scenario that you want me to run through, reach out to me at openlanefunding.com. You can book a call there, or you can just reach out, comment below. I got you guys. I look forward to talking to you guys soon. Next video is going to be dropping on Wednesday. Thank you guys, and I'll talk to you then.